Two Americans, same year, same New York town. In 2010, they each had $50,000 saved up. Mark grew up watching his parents lose money in the dot-com crash. He put his savings into a CD, safe, boring. He slept well. David used his $50,000 as a 10% down payment on a $500,000 townhouse. He signed a mortgage that scared him. He didn't sleep well for years. 15 years later, Mark's money has grown to $70,000. It barely kept pace with the local cost of living. David's house is worth around $1.2 million. After paying off his mortgage, taxes, and maintenance, plus adding his total rental income, he turned his $50,000 into a net profit of about $700,000. That is over 30 times the return Mark got on his savings. This isn't really a story about personal finance. To understand how Mark and David could end up this far apart from the same starting line, you have to understand a number that doesn't quite add up. Add up every dollar that actually exists in every bank account on the planet. The total is about 100 trillion. Now add up every dollar the world owes, about 350 trillion. Between what we owe and our total savings, there's a hole worth $250 trillion. Where did it come from? And, more uncomfortably, who do we actually owe it to? The answer is also the answer to why David got rich and Mark didn't. Stay with me. You've probably heard the line that every debt is somebody's asset. It sounds tidy. It's also one of the most quietly misleading sentences in finance because it implies the money had to exist somewhere first. In modern finance, that just isn't how things work. Money does not have to exist before debt does. As long as you can credibly promise to pay it back, money can essentially be conjured up around you. Let me show you what that actually looks like. Picture a glass-walled meeting room in Oslo Harbor View. Norway's sovereign wealth fund manager is staring at his screen. The fund holds about $1.7 trillion. We're going to zoom in on a tiny slice of that, $10 billion in cash, ready to deploy. He clicks once, buys $10 billion in US Treasury bonds. The cash leaves Norway's account, lands in the US Treasury's account. Total deposits in the world haven't moved by a single dollar. But the United States now owes $10 billion that didn't exist as debt yesterday. Click 1. Now those bonds are too valuable to sit there, so Norway lends them to JP Morgan, which immediately pledges those same bonds to a hedge fund. The hedge fund hands back about $9.8 billion in cash, keeping 2% as a haircut. No new money anywhere, by anyone. But another $9.8 billion of debt has slid quietly into the system. Click 2. The cash JP Morgan just borrowed isn't going into a vault. On Wall Street, idle cash is worse than useless. So the bank lends it to a private equity firm which scoops up bridge loans from 100 different companies, packages them, and resells the package to insurance companies for around $8 billion. Click 3, click 4. Stop and look at what just happened. A single $10 billion deposit walked through the system one time. It never multiplied, but it left almost $30 billion of fresh debt obligations in its wake. In the real world, this loop doesn't stop at 4 turns. It runs through 7, 8, sometimes 10 layers, each one shaving a little off the top, each one stretching the same dollar into another claim against the future. Here's the part that should make you tilt your head. Nobody printed any new money to do this. The Federal Reserve wasn't involved. There was no secret meeting. This is just what happens when collateral and trust meet a financial system that has gotten very, very good at extracting promises from very little real cash. That single mechanism, repeated millions of times across the global economy, is most of what fills the $250 trillion hole. Not a printing press, not a conspiracy, just the same dollar working overtime. Now, here's where it gets stranger. Most of those $100 trillion in deposits weren't really there to begin with either. Picture this. I unlock the doors of every major central bank on Earth at the same moment. The Fed, the European Central Bank, the Bank of Japan, the People's Bank of China. Every other one you've heard of, and a few you haven't. I gather every dollar, every yen, every yuan, every euro any of them has ever actually created, and put it all in one place. How small is the pile? Under $30 trillion. The Fed contributes about $7 trillion, the ECB just under $8, the Bank of Japan about $5, the People's Bank of China close to $7. Add the rest of the world and you still don't crack 30. That is the entire stock of base money on Earth, the only money any central bank has ever actually created. So if there are only 30 trillion of real base money in the world, where did the other 70 trillion in deposits come from? From the oldest sleight of hand in commercial banking, the one your local bank has been performing on you since the day you opened your first account and has never once explained. A deposit walks in. The bank lends 90% of it out. That loan becomes a deposit somewhere else. The next bank lends 90% of that out. The cycle keeps going until the original dollar has quietly multiplied into something close to 10. All of it feels real because it shows up on screens and statements with your name on it. But behind every dollar you can see, there's a much smaller pool of base money doing the work of something many times its size. If too many people try to cash out at the same time, it becomes very obvious which dollars were ever really there and which were just promises in a polite costume. This, by the way, is why some of the world's wealthiest people, when they suddenly need a few million in cash, sometimes can't actually get it. Their wealth, however staggering on paper, mostly lives in stocks, in real estate, in private equity stakes, and a huge chunk of it has already been borrowed against. When Elon Musk pays for an acquisition, he doesn't write a personal check. He pledges Tesla shares to a bank, and the bank lends him cash against them. It's the same machine the rest of finance uses to pledge treasuries for more cash. Top floor, bottom floor, same machine. What we call wealth is really borrowing capacity wrapped around a set of assets. Very little of it is the kind of cash that could ever sit untouched in a vault, which leads to a question almost nobody asks out loud. If a huge share of those deposits exist only because banks created them, then at the very bottom of this whole structure, who actually owns the real money? Every intuitive guess turns out to be wrong. Not governments. Almost every major government on Earth is a net debtor, shuffling money it doesn't actually own. Not pension funds. That money belongs to the workers who paid in, even when professional managers move it around. Not insurance pools either. That money is held in trust against future claims and ultimately belongs to whoever ends up filing one. The real owners are a much narrower group: corporate shareholders, family offices, a thin slice of individuals who happen to carry no significant debt of their own. Now, here's the part that gets a little uncomfortable. Lean in. If you belong to what most of America calls the middle class, homeowners, 401k holders, people who feel reasonably secure, there's a story you've been telling yourself. On paper, you are a net owner. Your total assets exceed your debt. But look closer. Subtract the mortgage, the auto loan, the student debt, and whatever else is quietly accruing interest in the background while you sleep. After that subtraction, you are a net liquid debtor who is merely sustaining assets that demand relentless, continuous cash flow. The moment that flow falters, the ownership you've built is easily unraveled. Okay, pull the camera back. 30 trillion in real base money, expanded by commercial banks into 100 trillion in deposits, leveraged again by financial intermediaries into 350 trillion in debt. Most people looking at that pyramid assume the 30 trillion at the bottom sets the ceiling on how much debt the world can carry. That assumption is wrong. The base doesn't set the ceiling. The real ceiling lives somewhere else entirely. To find it, you have to look at how different countries actually play this game, because the rules in Washington, Beijing, and Tokyo are not the same. Not even close. The world is running 4 debt models in parallel. The American one is by far the strangest. So let's start there. Paris, February 1965. Charles de Gaulle steps up to a microphone and accuses the United States of running essentially a financial scam. His complaint, in his own words, America has an exorbitant privilege. It can pay its debts in dollars it prints itself, while everyone else has to actually earn the dollars they hold. 60 years later, the privilege is still working exactly as advertised. Here's what most Americans miss about their own country's debt. A huge portion of it is owed to foreigners. Foreign creditors hold about $8 trillion in US treasuries. Japan alone holds over $1 trillion. China still holds close to $800 billion. The conventional wisdom says this is dangerous for America. What if foreigners stop buying? What if they dump? The conventional wisdom has it backwards. Because the dollar is the world's reserve currency, the United States can do something no other country on Earth can do. It can inflate its way out of debt without losing its creditors. Look at the receipts. A study from Harvard and the National Bureau of Economic Research found that the unexpected inflation of 2021 and 2022 alone wiped roughly $1.4 trillion off the real value of US federal debt. About $542 billion of that loss was absorbed by foreign creditors. China and Japan, the 2 biggest holders, each ate roughly a third. Heads, America wins. Tails, the rest of the world pays. Which leads to the obvious question, why does anyone keep playing? The uncomfortable answer is they don't really have a choice. The US is the largest deficit nation on Earth. Most international trade still settles in dollars, so when other major economies sell things to America, they get paid in dollars, and those dollars pile up. Those dollars have to come back somewhere. US Treasuries are simply the deepest, most liquid, most politically convenient place to put them. There is no second best. Try a thought experiment. Tomorrow morning, China, Japan, and Germany decide they're done. They convert their entire trade surpluses into physical assets: gold, copper, iron ore. What happens? The dollar recycling chain breaks. The US trade deficit has to violently contract. The dollar swings wildly. Global trade seizes up while everyone tries to figure out what should replace the dollar as the universal medium of exchange. Spoiler, there's no good answer. So, nobody does it. Holding US debt isn't just an investment decision, it's holding the relationship itself. This is also why America's relationship with inflation is structurally different from everyone else's. When inflation runs hot, America's real debt shrinks. The cost is paid by everyone holding dollars. When inflation cools, the dollar strengthens, and American capital flies out across the planet to buy distressed assets at fire sale prices. Some economists who prefer polite vocabulary call this seigniorage, a quiet currency tax collected from everyone who isn't holding the printing press. There's also a quieter mechanism almost nobody talks about. US federal tax revenue has grown by roughly 30% over the past 5 years. The size of credibly issuable Treasury debt scales with tax revenue, which means America's debt ceiling has effectively risen by a similar percentage. When the next rate-cutting cycle arrives, the ceiling will expand again. This particular ratchet only ever turns in one direction. And, before you ask, no, the yuan isn't going to fix this. For a currency to circulate globally, the issuing country generally has to run trade deficits, exporting its currency the way the US has done for half a century. But China runs trade surpluses with most of its partners, which means those partners are perpetually short of yuan, not flush with it. The math eventually runs out. This is the Triffin Dilemma in modern dress. A country can either run a persistent export surplus or it can supply the world with its currency. Doing both at once is extraordinarily hard. So the dollar's role isn't just stubborn, it's structurally protected. A growing number of economists now describe US Treasury debt not as a disease, but as the engine of global capital flows, an engine so large that every major economy already has skin in the game, which means creditor nations are effectively forced to defend dollar credibility just to protect their own balance sheets. Too big to fail no longer just describes a bank. It now describes a country. So here's the punchline. The maximum amount of US debt isn't really capped by base money at all. It's capped by tax capacity and by the political willingness of foreign buyers. As long as that demand keeps expanding, the Fed only needs to top up base money in small doses to enable enormous waves of new debt. Which is why America's $7 trillion in base money isn't the cause of its $100 trillion debt economy. It's the consequence. Across the Pacific, China runs the inverse experiment. Capital flows in and out of China are tightly supervised. On the surface, that should mean Federal Reserve rate moves don't blow directly through Chinese markets. The reality is more tangled. For most of the last 2 decades, a huge share of China's base money was created passively, through a mechanism called foreign exchange position. Every time Chinese exporters earned dollars, the central bank converted those dollars into yuan. The dollars piled up in foreign reserves. The new yuan poured into the domestic banking system. That tide of money had to go somewhere. For 2 decades, the somewhere was housing, which is one of the main reasons property prices in cities like Beijing and Shanghai rose far faster than wages. When inflation appears in China, it's absorbed almost entirely by domestic depositors. Whoever holds the most cash takes the biggest hit. Other countries also push inflation onto their savers, but most have open capital accounts, which gives wealthy citizens an escape hatch into dollars or gold or property abroad. China's escape hatch is narrower and the people who can use it are fewer. Here's the part most Western commentary gets wrong. China's overall leverage looks heavier on paper than it actually is. Government and large state-backed enterprises borrow against unusually strong credit. Real estate borrows against land and physical buildings. Both support higher leverage than would be possible in an economy dominated by intangible services. Combined with relatively independent rate policy, this lets China cut while the US is hiking and quietly bring leverage down in the process. For once, in these past 3 years, the people sitting on cash have actually been winning, not losing. 2 countries, 2 opposite games, same global system. Now meet the third one, the strangest of all. There's a woman in Osaka, 80 years old. She lives alone in an apartment her late husband bought in 1978. She still folds the bills in her wallet a specific way her mother taught her decades ago. Her bank pays her almost nothing on her savings. She doesn't move them, she doesn't even consider it. Her account is one of millions exactly like it, and together they are quietly holding up the strangest debt structure on Earth. Japan's gross debt to GDP ratio is roughly 260%, the highest in the developed world. The Bank of Japan owns more than half of all outstanding Japanese government bonds. The interest rate on those bonds, until very recently, was effectively zero. A country with debt that big, paying interest that small, should not be functioning as a stable economy. And yet, for 30 years, it has. Which means there's something holding it up that doesn't show up clearly in standard economic models. That something is her. On paper, Japan's capital flows are almost completely free. Anyone can move yen abroad, anyone can buy foreign assets. But culture and demographics function as a soft form of capital control no law could ever imitate. Sure, the famous Mrs. Watanabes do shift yen into higher-yielding currencies, hunting for any margin of return. But they're a niche, not a tide. The vast majority of Japanese savings sit year after decade in low-interest yen accounts, held by pension funds, insurance pools, government-linked entities, cash-rich corporations, and elderly citizens like her who have lived through enough financial cycles to know that safety is its own form of wealth. Together, they form a captive pool of savers who fund the government almost for free. That's the actual secret behind those astonishing debt numbers. And because Japan has had almost no inflation for decades, that cheap yen has become the favorite raw material of global finance. This is the carry trade. Hedge funds borrow yen at almost zero, sell the yen for dollars, and invest the dollars in higher-yielding assets all over the world. For most of the last decade, it was one of the most reliable trades on Wall Street. Then, on August 5th, 2024, something happened. Picture a trading floor in Connecticut. Wednesday morning, US time. A junior analyst sees red on his screen, then more red, then the kind of red that doesn't usually happen. The Bank of Japan had quietly adjusted rates upward by a fraction of a percent. The yen surged. The carry trade began to unwind under pressure. The Nikkei fell over 12% in a single session, its sharpest drop since 1987. $700 billion of stock market value, gone in hours. The carry trade unwind was widely seen as one of the main drivers. Now think about what that actually means. The chain is shorter than you'd expect. That elderly woman in Osaka has never met anyone on Wall Street, probably doesn't know what a hedge fund is, but she's wired directly into the New York stock market. Her decision to keep her savings in yen, made for the most personal reasons in the world, made decades before anyone invented the carry trade, helps fuel a position that, when it breaks, can crash markets thousands of miles from her front door. That's how tightly the system is wired. Okay, let's bring this all home. Closer than maybe you'd like. Remember Mark and David? I told you their story at the start, but I didn't tell you what it actually means. Now you have enough context to see it clearly. Mark and David didn't end up in different places because David was smarter, or luckier, or worked harder. They ended up in different places because David did one thing Mark refused to do. He borrowed at the right time for the right asset, in a system designed to reward leverage. He understood, maybe without being able to articulate it, that in this system the people who refuse to take on any debt aren't being prudent. They're being quietly punished. The people who learn to borrow against the future end up owning a much larger share of it. That's not a moral statement. It's a mechanical one. It's how the architecture works. Multiply Mark and David across an entire generation, and you get something that has a name. It's called financialization. It's what happens when the economy stops rewarding labor and starts rewarding leverage. When working hard and saving turns out to be the slow road, and signing a mortgage at the right moment turns out to be the fast one. When the gap between the people who borrowed and the people who didn't widens for decades and never closes. For nations, the picture is similar, just stretched across centuries instead of decades. Almost no major country has ever paid down its national debt to zero. Most haven't even tried. Two examples that should bend your brain a little. The British government still pays interest on bonds first issued during the Napoleonic Wars, 2 centuries old, still earning a coupon. Argentina has defaulted on sovereign debt 9 times since independence. It's still borrowing today. Lenders keep showing up. Debt isn't something modern states actually repay. It's something they perpetually roll over. Almost every country is quietly betting on one of 3 escape routes. Either the next technology wave spikes GDP enough to shrink the debt-to-GDP ratio on its own, or the bill gets politely passed to the next administration, with a smile and a handshake, or a global wave of inflation dissolves the problem before it becomes unmanageable. America has the most agency in choosing among these three. Most other countries are just along for the ride. Beneath all the variation, there's one limit no country escapes. It's brutally simple. Total debt cannot grow indefinitely if the interest on that debt grows faster than the productive output of the society paying it. Which is why where the debt is going matters far more than how much of it there is. If debt flows into infrastructure, into research, into investments that produce real cash flows for decades, it acts as a wealth multiplier. The interstate highway system, built partly on debt in the 1950s, is still earning returns for the United States today. TSMC's foundries, financed by years of strategic debt, generate global value far exceeding their borrowing cost. But if debt flows mostly into consumption, into entitlements, into pensions for shrinking workforces, it isn't really investment at all. It's a sunk cost being pushed onto the future. A picture might help here. Drive about 100 kilometers north of Madrid and you'll come across an airport. Brand new, pristine, empty. Spain spent a decade building airports like this one. Some of them have never received a single commercial flight. Investment without return is just consumption with a longer delivery time. And there's a second thing worth saying out loud. Even when total wealth genuinely multiplies, if the gap between the top and the rest keeps widening, the system eventually breaks anyway. Because the consumption loop that supports the entire structure depends on ordinary people having enough money to actually buy things. Once they don't, the loop snaps. And no central bank can print its way back to a working middle class. Here's where it lands today. A large slice of that $350 trillion debt mountain wasn't borrowed to build the future at all. It was borrowed to fund consumption, to pay for promises politicians made to voters who are now retired, which is why a growing number of economists believe the world is now entering what they call a debt readjustment phase. Through interest rate policy and capital controls, governments are quietly trying to pull money out of bloated entitlement systems and government debt chains and redirect it toward assets with strategic geopolitical value: energy, minerals, and rare earths. The critical technology supply chains that will define the next 2 decades of global power. Most Americans think the recent surge in interest rates is punishment. It isn't punishment. It's sorting. Every quarter, higher rates make consumer borrowing more expensive. That pain is real, and it's reallocating the world's capital. Slowly, but unmistakably. Strategic resources, by contrast, are far less sensitive to interest rates. Their scarcity gives them natural pricing power. Lithium doesn't care what the federal funds rate is. Neither does a semiconductor fab. These are the assets that can absorb expensive financing without breaking. Whether you're a saver, a homeowner, an investor, or just someone trying to plan a career through all of this, this is the part of the picture you should be watching most closely, because it determines which assets keep their value over the next 20 years, and which quietly get hollowed out. There's one wild card nobody has fully accounted for. It might end up mattering more than every policy debate combined: artificial intelligence. If AI delivers even half of what its strongest proponents predict, it could lift global productivity sharply enough to validate enormous amounts of debt that would otherwise look unpayable. For most of human history, debt was a thing between neighbors. We've now built a system where the chain is much longer. It runs from your savings account, through a bank you barely know the name of, through a hedge fund in Connecticut, through a bond issued in Brazil, through a pension fund in Australia, and eventually, quietly, into a child who hasn't been born yet. She didn't sign the loan. She doesn't get to vote on the rate. She'll pay it anyway.